When buying or selling cryptocurrency, the amount ultimately received may differ from initial expectations due to fees. At the end, you'll have a clearer picture of how exchange fees work and how to minimize them within a disciplined trading or investment process. Let's get into it. Crypto exchanges often advertise low or competitive fees, but understanding the full cost structure is essential for managing trading and investment expenses effectively. At Numeratus, we treat fees not as minor friction, but as a structural variable that compounds over time, especially for active participants. This guide examines the fee mechanisms on major U.S. regulated exchanges, Coinbase, Kraken, and Binance US. It outlines common fee types, provides examples based on current structures as of 2026, and highlights strategies to reduce unnecessary costs. When buying or selling cryptocurrency, the amount ultimately received may differ from initial expectations due to fees, spreads, and execution mechanics. Many platforms prioritize user-friendly interfaces for accessibility, but these often come with higher implicit costs compared to advanced trading options. By reviewing fee schedules carefully and using the appropriate tools, users can meaningfully reduce expenses. This analysis focuses on exchanges available to U.S. users and reflect the type of operational detail Numeratus emphasizes when evaluating platforms, liquidity venues, and capital efficiency. By the end, you'll have a clearer picture of how exchange fees work and how to optimize them within a disciplined trading or investment process. Crypto exchanges apply multiple fee layers that collectively determine total cost. The advertised trading fee is only one component. Others include spreads, withdrawal fees, deposit fees, and slippage. The spread is the difference between an asset's buy and sell price. On simple or instant purchase interfaces, the quoted price often embeds a spread, commonly 0.5% or higher, which represents the exchange's margin. This is typical for beginner-facing interfaces and disclosed in terms of service rather than at execution. Withdrawal fees cover the cost of transferring assets off-platform. These include underlying blockchain network fees, sometimes with an added exchange markup. For example, Ethereum withdrawals involve gas fees that fluctuate with network congestion. Yet exchanges may charge a fixed fee that exceeds real-time network costs. We may have fiat deposits and withdrawal fees, and they vary by method. Credit and debit card deposits typically incur fees around 3 to 4% due to payment processing costs. Bank transfers, such as ACH, are usually free, but involve settlement delays of several business days. At Numeratus, these components are evaluated together, not in isolation, because total friction, not headline fees, determines long-term efficiency. Now let's look at Coinbase. Coinbase is designed for accessibility, offering both a simple purchase interface and an advanced trading platform. Fees differ substantially between these options. So let's look at a simple example. You buy $500 of Bitcoin through the main Coinbase application. The spread is approximately 0.5%, adding about $2.50. Now let's look at the payment method. The debit card fee of 3.99%, adding about $19.95 to those fees. And then you have the total estimated cost is roughly $22.45, or about 4.5%. Reduced fees. Users can switch to Coinbase Advanced Trade, which uses a market trader model available to all customers. For monthly volumes under $10,000, the maker fee is less than 0.5%, and the taker fee is a little bit more than 0.5%. Using the same $500 example, an ACH deposit is $0. The maker fee limit order is about $2. This reduces total cost materially. Withdrawal fees are network dependent. For Bitcoin, this may be a fixed amount, such as a very minute fraction of Bitcoin, regardless of the transaction size. From a Numeratus standpoint, Coinbase illustrates how interface choice, not asset choice, often determines costs. Let's take a look at Kraken. Kraken is known for relatively transparent fee structures and offers both instant and professional trading options. They have a function called Instant Buy. It's a trading fee of 1% per transaction. The spread included in the quoted price. For a $10,000 instant purchase, fees can approach $100 plus the spread. Now let's look at Kraken Pro. And this uses a maker-taker model with fees decreasing as volumes increase. At the lowest tier, maker is much less than 0.5%. And the taker is still less than 0.5%. A $10,000 limit order executed at a maker would incur about a $25 fee. So here's some strategies. potentially default to Kraken Pro. Use limit orders when possible. Batch withdrawals to reduce repeated network fees, which vary by asset and network. Fiat deposits via ACH are free. Hard deposits incur additional fees. Kraken demonstrates how execution discipline directly affects costs, an approach aligned with Numeratus' emphasis on process over convenience. Now let's take a look at Binance US. Binance US advertises low headline fees, but its structure includes tiers, discounts, and conditional benefits. Certain Tier 0 pairs have a 0% maker and less than 0.1% taker. Other pairs follow a tiered system based on a 30-day volume. 5% fee discount is available when paying fees with BNB. However, holding BNB introduces price volatility risk that should be weighed against fee savings. Withdrawals, fees are dynamic and dependent on network conditions and asset type. This is shown at confirmation. Crypto deposits are free. Binance US experienced operational disruptions in 2023, but as of 2026, services are active. And Numeratus fee discounts tied to volatile assets are evaluated cautiously as they shift risk rather than eliminate cost. And here are some potential strategies to reduce risk. Across exchanges, consistent patterns emerge. Simple buy-sell interfaces can carry high implicit costs. Across exchanges, consistent patterns emerge. Simple buy-sell interfaces carry higher implicit costs. Advanced trading models offer lower fees through maker-taker models. Here are some key strategies to think about. Avoid instant buy-sell buttons when possible. Use limit orders to qualify for maker fees. Favor bank transfers over credit card payments. Maybe batch withdrawals to reduce network fee repetition. Compare exchange withdrawal fees with real-time blockchain network costs to identify markups. These practices reflect the same principle Numeratus applies across markets. Small frictions compound when ignored. Crypto exchange fees are structured to balance accessibility with operational costs. Platforms like Coinbase, Kraken, and Binance US provide tools to manage these expenses, but users must actively choose lower-cost paths. By understanding fee mechanics, using advanced features, and planning transactions deliberately, traders and investors can retain more value over time. At Numeratus, this type of analysis fits into a broader focus on capital efficiency, infrastructure selection, and disciplined execution. Fee awareness is not just about saving money, it's about maintaining structural advantage.